Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, we're talking about making you some money this morning, right? How to double your returns potentially. Because what did I just share with you so far this morning? The S&P 500 index, right? That's the 500 largest companies in the United States, makes up 70% of the equity in the stock market, outperforms 96% of equity mutual funds out there, and over the last 15 years has only averaged about 3% per year over that period, right about the same rate as inflation. And so we also showed you with Dalbar that the average investor earns about half or less than half, maybe even a third of what the equity investor, that is, of what the S&P 500 index did. So let's just stick with half, okay? We'll be generous. So that means over that same 15-year period, the average investor earned maybe 1 to 1.5% over that same 15 years, less than the rate of inflation. So this is a problem, isn't it? We've got to stay ahead of inflation. We've got to account for taxes. And as we start taking a withdrawal, we've got to account for that if we want to make sure that we never run out of money. Right? If we want to make sure that we can attain and maintain our standard of living and quality of life no matter how long we live, then we've got to make sure that our money lasts as long too, right? And that it is be able to provide us the income we need, and that income can ratchet up with inflation. You know, if it took a couple today to put the inflation part in there, this is why this is so important. It's why save money, when you can go over and put it in savings or checking or CDs, savings bonds, treasuries, all of these things, they're not paying anything. They're not paying enough to stay ahead of inflation, and that's the problem. Okay, because with inflation, for a couple, let's say, if you needed $100,000 a year to live on, okay, that means that in about 10 years' time, you're going to need somewhere around $135,000, okay, and that's if inflation stays as low as it currently is, or right around that average over the last 15 years we talked about. When you think of it over the last 40 years, it was actually higher. It was over 4%. So inflation's a real problem for us, isn't it? If we look at 20 years, that you'd need like $160-some thousand, $170,000 to buy what $100,000 buys today. Okay, so you could do that. You could cut that in half. You say if it took you $50,000, then you're going to need about $80,000 to $85,000. So where's that money going to come from if your investments can't keep up with inflation, be able to pay the taxes when you start taking money out of those retirement accounts, as an example, and keep up with the withdrawal rate? So if you're taking out 3% of your portfolio to live on, and you've got 3% inflation that you want to keep up with so that you can maintain that spending power, and say 1% of that earnings is going out in taxes, then you're going to be needing to earn around 6 or 7% potentially, right? Or you need a plan where you can have that guaranteed income maybe based on a smaller amount. So there's a lot of ways that we're going to do this, but one of them is understanding how this whole thing works, okay? So let's talk about some of the myths that can create these problems. So I'm going to show you another slide. This is slide number 3. We'll put this up there. This one has to do with, again, this is Dalbar. It's an independent research group for the average, that tracks investor returns and investor behavior. And you can see over the last 12 months, the very bottom line there on the chart, over the last 12 months, the equity fund average was 5.5%. Now, by this 12 months, by the way, they're talking about 2014 on this. So this period is calendar year, January 1st to December 31st of 2014. The average equity fund earned about 5.5%. And you're thinking, well, that's not so bad, right? But the S&P 500 index, if you look over to your right, second column from the very end, you see earned about 13.69% over that same period. Now, most people don't invest 100% in stocks, so let's say they blended bonds and stocks. So now let's take a look, if you will, at the column that says fixed income funds, third one in from the left. And that bottom line, it earned 1.16%. So these are your bond funds as an example. Now go all the way to the right, and the Barclays Aggregate Bond Index, so similar to the S&P, right? But this one's a bond index, earned 5.97%. Oh my goodness, right? So again, we're seeing that these mutual funds are not keeping up with the indexes, not by a long shot. Now, if we blend those two together the way many investors do, maybe say 50-50 stocks to bonds, and you see now a return of about 3.5%, If you look at the composite fund investor, in fact, it's almost 4% over that same period, all right, for 2014. Now, if we blend together the S&P and the Barclays aggregate bond, we would have got almost 10%, more than double what the average investor. You can see this benefit maybe of coming through indexing and then inflation flowing in. So let's take a look at indexing. All right, let's talk about that. One of the things that comes with indexing, there's a better way even yet that we're going to do this. But let me first start with setting up some of the myths that are out there that create these problems. One of them, why does the average mutual fund investor do so poorly compared to the S&P 500? All right? Well, one of those is market timing. Now, sometimes it's the investor that's getting out of the market at the wrong time and into the market at the wrong time. But it can also be, even if the investor did exactly the right things and said, this is what I'm going to do and I'm staying there, the mutual funds are investing in, the money managers that run those mutual funds, they may change things. They may call it tactical asset allocation, but what it means is they're getting out of the market, right? Or they're pulling out of a certain asset category because they think it's wrong. So they're concerned that large caps have had a run and they're going to go down, and all of a sudden they switch over to maybe mid caps, or they go more in cash, or whatever it might be, depending on the type of fund you have. This creates a problem. Even if you do the right things, if you're in an actively managed fund, now you got to worry about what that money manager is going to do. So let me show you an example with slide number 5 here. This is about market timing. So whether it's you, the investor, that's doing the market timing, or let's say you're a really disciplined, good investor and you're staying invested and you got to worry about your money manager. So what slide 5 shows why market timing doesn't work. It shows what happens if you stay fully invested versus if you don't. So let's see if we can get that slide up for you. All right, on this one, if you stay invested, we got that one? So slide number 5, why market timing doesn't work. It basically shows the growth of $10,000 investment over the periods. So if you stay invested, for instance, a $10,000 investment you can see there on the left, all right, would have grown to almost $70,000. But look what happens. Now this is from January of 1995 through December of 2014. Over that last 20 years, the last 20 years, we'll say, 5,000 trading days, over 5,000 trading days. If you stayed invested the whole time, then that's it, you did well, right? You made almost 70,000 on your 10,000 investment. But what happened if you missed just 5 days? Think about that. Out of 5,000 days, you missed just the best 5. It would have knocked your return tremendously down to a little over 40,000 instead of well over 60,000. And if you missed 10 days, it would have cut your return in half. And as you can see, the more days missed, the worse it gets, to where you're lucky if you have a break even if you just miss 30 days out of 5,000 days. All right? And yet that's exactly what happens. Investors get nervous, they can do it, but it's not, even if, like I said, even if you're a really disciplined investor and stay disciplined and stay in the market, your mutual funds may not. Okay? They may create this problem for you. Here's another problem. All right, and this goes with turnover. All right, so on slide number 6, we'll put that up. This is bid-ask spread. One of the things, what this means is this. When you look at your mutual funds, and this is why it's so important to understand how the markets work and how the industry, the mutual fund industry works. So if we can get up slide 6 here. What this shows is basically every time there is a trade, every time a stock is bought or sold, there is a cost involved. This is an example. The selling price of the stock is $49.50, let's say. Okay, it was actually purchased for $50, and the market maker, those guys you see on TV running around when they show the stock market floor in the funny coats, that's the market makers making money in between on those trades. Okay, now imagine that's one sold and one bought. Now we just created $1 on that particular trade. All right, the more expensive the stock, the less impactful this is. But if it's a smaller company, if these are $10 a share or $20 a share, all of a sudden that can be a real problem. All right, can drive up your costs, and it doesn't show in your prospectus, and it doesn't show on your statement. Okay, but I'll show you how you can find out. All right, so here's how you do it. We can go ahead and get rid of that slide now. One of the ways that you can do it, there's a thing called Morningstar. So when clients come in, we do an analysis of their portfolio. This is what we do. We'll pull out Morningstars and we'll look at the turnover ratios as one of the areas that we look at. The higher that percentage, if they're turning, and you see funds sometimes that turn over 200%, okay, mutual funds, that means they sold everything in there twice, okay, and bought all new stuff. That's going to have a tremendous impact in terms of driving up your trading costs and reducing your net return, but it's not something you even see on your statement. All right? In other words, it doesn't show as a line item, oh, trading costs, here it is. No, it's just you got to look at turnover ratio and understand the impact of that. So that's one. All right? So there's one way that you can see into your funds how they're doing. Now here's another. When you're looking at those, the other is the holdings. Okay, do you have actively managed or passively managed funds? All right, what does that mean? One of them, that average investor, they're investing in actively managed funds. So what that means is they are giving their money to a mutual fund manager in this mutual fund, and that manager is going to go out and let's say it's a large cap fund. Well, they may only buy 50 to 100 stocks that fit that large cap category. In other words, the S&P 500 index is the large cap, right? So that means that they buy maybe 1/10, okay, maybe 50 to 100 of those 500 that they think are going to outperform the 500 as a whole. What's the problem? It doesn't work. That's what we just showed you the results, right? So that's another area that can create problems for you. All right, when we come back, we're going to take a quick break. When we come back, I'm going to finish up with some of these myths that are setting you up for failure, and then, all right, the fun part, I'm going to share some truths with you about the market that can help you, in fact, now succeed, all right, how to get more money on your money. So join us here. We're going to be right back on the Retirement Report.